2 o'clock. Let's get started. Welcome to today's PENTalk. I'm Beth Parker with Pentegra. We're glad you've joined us today. We're pleased to present Safe, Stable, Secure, a tax-advantaged retirement plan with guarantees. I have a few housekeeping items I want to review before we get started. If you have any questions during the presentation, please submit them through the question box located on the control panel on your screen. After the presentation, we'll answer as many questions as time allows, as we want to ensure we are respectful of your schedule and end on time. If we don't get to your question today, we'll definitely follow up with you afterwards. Stored on your control panel in the handout section is a copy of today's presentation. I invite you to download this resource now or at any point during the webinar. Today we're joined by Mary Reed, Pentegra's National Director of Pension and Protection Planning, and Jim Heiza of Compass Strategies. Mary has over 30 years of experience designing and establishing qualified retirement plans for closely held businesses. Mary's expertise has made her a frequent speaker and contributor to financial industry publications. Jim has over 20 years helping individuals, families, and institutions with financial planning and investment management. As a CPA, Jim educates small business owners and other CPAs about the tax deductions and benefits of qualified plans. Mary and Jim, hello and welcome to you both. Let's get started. I'll kick it off, Mary.
All right, thank you very much, and welcome everybody. I'll let Jim say hello, and then we'll just jump into the information.
Hello, thank you.
So you'll hear from both of us. We'll just kind of go back and forth. We're going to talk actually about two things today that we cover in the book. The first being 412E3, which are fully insured defined benefit plans, a pretty misunderstood section of the code. And then we'll talk about getting the money out of the plans on a tax-favored basis in the last portion. Come on, slides, go forward. There we go. Okay, so for doing 412 plans, this is all tax deductible to the business, so the conversation also often starts with a discussion about tax deductions. And we've seen activity driven up by the Tax Act that we're under now, the latest Tax Act, Section 199A. And I don't know how many of you out there might have been following. Certainly a lot of the CPAs have been wrestling with this over the last couple of years. And 199A provides a 20% deduction for pass-through entities. So this was the answer to C corporations getting the really low 25% tax bracket. For pass-through entities who aren't eligible for that, there's this 20% deduction. However, some companies lose the deduction. So we have to kind of define the terms. Pass-through entities we're talking about here, so pretty much anybody other than a C Corp, S Corp, sole proprietors, partnerships, LLCs, taxes partnerships, are all subject to this, potential 20% deduction. But if you are a service trader business, you lose this deduction if your income is over the defined threshold. So service industries would be all the things you kind of think of, medical fields, accountants, actuaries, law, professional services, pretty much any business where service is the offering, not a manufacturing facility. So if you're in a service business and your income is over the threshold, you will lose this 20% deduction. So the threshold for someone filing single, it phases out from 160,000 to 160,700 of income to 210,700. That's 2019 numbers. So if your income is below the 160,000, you would get the deduction. If it's over 210, you would lose the deduction. And if you're anywhere in that phase-out range, you would get a proportionate amount, a prorated part of the deduction. This definition of compensation is total taxable income, not just income from the business. Now, if you're married and filing jointly, it phases out from $321,400 to $421,400. And keep in mind, this is total income. So you might have someone who has a business, it's a service business, and maybe their income from that business is $250,000. but they're married to someone who works somewhere else, as a W-2 employee, and they have $200,000 of income. Well, their combined income exceeds $421,000, so they would lose this 20% deduction. So what does this mean for businesses? So here's a little sample business. We've got an S corporation here, one owner. Sylvia here is the owner, generates $1 million of revenue. It takes $500,000 of taxable income, $200,000 on her W-2, and $300,000 comes through as pass-through on that sub S. She is a service business, so she does not get the 199A deduction. Her federal income tax bill is $126,379. Now, if we had put in a defined benefit plan for this person, we could put in a plan for her where she could contribute $200,000 to this plan. So now that's all deductible. So that reduces her taxable income by $200,000. So now instead of it being $500,000, it's $300,000. That brings her below the threshold. She gets back her 199A deduction of $20,000, and now her total tax bill is only $55,779. She had enough cash flow left that she needed to live on, but now she's got $400,000, $444,000 working for her because that money went into a plan for her. She didn't give it away. The $200,000 she just kind of shifted sideways into this fully insured plan, and it's growing for her. This is what we've had a lot of business owners coming to us looking to do in the last couple of years. Their income is above that threshold, and they need these deductions to bring it down. If we did a 401k plan for this person, she can only put in $56,000. If she's 50 or older, she could get another $6,000, so we could get her up to $62,000, but that's it. And $62,000 would not be enough to get her back her 199A deduction. So we've had a lot of people coming to us looking for those deductions. So here's our world of qualified plans. The ones at the bottom of the pyramid have the biggest deductible contributions. Those would be defined benefit plans, traditional defined benefit plan. That's the kind of defined benefit plan that's been around since the 1930s. You'll receive a benefit at age 65 of 20% of pay, something like that. Then we have fully insured. We'll dig into that a little deeper. And what makes the fully insured defined benefit plan unique is that it's all guaranteed. Above the line, we have the defined contribution plans, 401k, and profit sharing. That's where you're limited in how much you can contribute. That's $56,000. And in between, we have cash balance, which are hybrid. Now, we're not going to talk about those today. That would take a couple of hours all in itself. But we're going to talk about the fully insured defined benefit plan. That's where we've seen a lot of interest lately, and that's what we wrote the book about because people were coming to us. At the top of the pyramid is the distribution aspect, and that will be the last part of our presentation today. How can we get those monies out on a tax advantage basis? So why would companies do a qualified plan? It's usually driven by tax deduction. Everybody wants to pay less taxes. Anything they contribute is currently deductible and not taxable if current income as an individual. Anything that's in that plan will grow tax deferred. It will be taxed when it comes out, and that's why we get to the distribution side. And you can have insurance in there if you want to add death benefits as well, and if you do, they will be tax-free. Retirement reasons, sometimes we're actually talking to people who will need to save money for retirement, and this is the most efficient way to do it. So if we're talking to that business owner who wants to retire in 5 years, putting $56,000 away in a profit-sharing plan won't get them what they need, but if we went to a defined benefit plan, maybe they could put away $200,000 a year, and that will help a lot. So if we go into a traditional defined benefit plan, you can make those large contributions, and then how much you contribute ongoing will partly be a result of how your investments do in that plan, whether you make money or lose money. If we do in the 412, we don't have that fluctuation because it's all guaranteed. The other thing in any of these qualified plans, if you have one rank and file employee in there besides the owner, everything in that plan is fully protected from creditors, and no one can take it away from that person. No one can gain access, except the IRS and your spouse, but other than that, nobody can get at that money. All right, so let's take a look at a little sample case. Come back. All right, so here's a little sample company, very typical. We have Pat and Chris. They're a married couple. They own this business. We've got them both making $280,000. They might even be making more than that, but we can only recognize what's allowed in the plan. Their child Drew is in the business with them, and they have 2 employees. So if they did a profit-sharing plan, we can make this plan very favorable for them. We've got $56,000, that's the maximum, going to each of the owners. Drew is just kind of along for the ride, and all we're giving these two employees is $2,250 and $1,500. This is what's called a new comparability profit-sharing plan. So when we look at what this plan costs, the total plan contribution for all 5 people is $121,750. They gain tax savings, right? It's all deductible. At a 35% tax rate, their tax savings is $42,612. So their net out-of-pocket actual cost for this plan is $79,138. And the family members are benefiting from $118 of that $121,000 contribution. The IRS is kicking in part of that with the tax savings. So they have a net gain of $38,862. It's a very positive economic stand. Even though they had to contribute $37.50 for those 2 employees, they didn't cost them anything. That came out of the tax savings. Well, a 412(e)(3) plan will do the same except with much bigger numbers. Now, if we went to a traditional defined benefit plan, you can see here, look at these numbers. Instead of $56,000, these numbers are driven by age and pay. $199,000 for Pat and $161,000 for Chris. Now, the employee, this employee went up as well because they're older. Age and pay will drive the numbers here, but still relative to the owners, it's a very small amount. All right, so if we want to step into that defined benefit world for those higher contributions, now we start to think, what else do we want that plan to do? By going into any kind of defined benefit plan, we know what the benefit will be. We're funding to the benefit. The contributions will be whatever is required to get there. If we add life insurance, we'll also have guaranteed death benefits. We have the protection from creditors if we have a rank and file employee in there, and it's all income tax deductible. But what a 412 does, as I said, it's the same as any defined benefit plan, except that the underlying investments that support these benefits can only be guaranteed level premium annuity contracts. And you can have life insurance. You don't have to. You can if you want. It has to be whole life if you have insurance, and that both products have to be from the same company. Now, these were not created by insurance companies. So they might sound like they are, but they weren't. They were created by the IRS, and they were created during the Depression. These go back to the 1930s. Because in the IRS's point of view, this is a way to really provide a guaranteed retirement benefit. So there's no market risk. It doesn't matter. You know, you're not investing in the market up, down. It's you know, the annuities stand behind it with the guarantee in those contracts and the life insurance as well. So it takes the risk out of it. Now, we see life insurance in lots of these plans. You can have it. Does it make sense? You know, people do die. Statistics tell us 3 out of 20 will die before they reach age 65. And for those who reach age 65, you know, everybody will die eventually. So if you include a death benefit here, that death benefit will go to somebody someday. And the reason people include it here is because it's a less expensive way to pay for it. So here's a little typical, I'm going to make company a little smaller. This is a typical 412 client. We've got the owners and 1 employee. Now look at the contribution. You know, in that profit sharing plan with everybody, we were at $120,000. Here, just doing the annuity, we have a plan contribution of $555,000. If we add the annuity, we can take it up to $720,000. If we add the life insurance, we can take it up to $723,000. And we just added 3.9, 4.7, and the employee gets some insurance too. Of guaranteed death benefit, all paid with pre-tax dollars. Now, these numbers may look too large, but there are companies and employers who are looking for these kinds of deductions. Imagine this was a doctor, or Pat and Chris had some really successful business. Maybe they're on the web. We get some of those people. And their earnings are $1 million. And they're a service company. Remember that $199.8 deduction, they don't get it. But if they put in this plan with a $723,000 deduction and now their taxable income was $300,000, not only do they benefit from this deduction, but they get their $199.8 20% back as well. So how much does this cost? If they make the $723,000 contribution, their tax savings at a 35% tax rate is $253,368. When we add the insurance to the plan, the contribution from just annuity to adding the life insurance goes up $168,000. After the tax savings out of pocket, it's just under $133,000. But look at the premiums for the life insurance, $333,000. This is a way to pay $333,000 of premium for an out-of-pocket cost of about $133,000. There's nowhere else to do that. If they were to buy this insurance outside the plan, they'd have to have gross earnings, I don't know, 500 something, pay the tax, net the $333,000 to buy that same coverage. This is why we see life insurance in a lot of these plans. The other thing is that we can't eat away at the retirement benefit. The insurance lays on top. So here's not that same person, but another person. If this person were funding for a benefit at retirement equal to a lump sum of about $1.3 million, they're along the way, and let's say they die halfway there. Their accrued benefit in the plan, which is what would go to their beneficiary, is $712,000. If we added life insurance to this plan, same accrued benefit, same lump sum at retirement, but now if they die while they're still in the plan, in addition to the $712,000, their beneficiary will get this tax-free death benefit on top of there. Just like insurance would do outside the plan, it does inside the plan, pure death benefit protection. Now, here's the other major factor between traditional and 412 plans, right? The benefit limits are the same, but it's how we get there. This is looking back over the last 10 years. This is someone we're looking for a contribution of $200,000 a year. If we do a traditional defined benefit plan, we start here at about $135,000. Next year, we contribute our $208,000. Year 3, we drop down to $108,000, then $114,000, then we jumped up to $253,000, down to $142,000, down to $0. By the time we get to year 9, we're all the way up to $316,000. It's jumping all over because this money is invested in the market, and depending on how the market is doing, if we made more money than we anticipated, our next contribution will go down. If we lost money, our future contributions will go up because we have to end up with the same amount of money at the end of the day. And we have to adjust accordingly. But if we did the same plan as a fully insured plan, right, we're funding on the guarantees of the contracts, we don't have that fluctuation. And you can see the contributions here range from $218,000 to about $203,000. They stay right in that corridor all the way through the life of the plan. So this is something that business owner can plan for, budget for, and know exactly what they're going to do, as opposed to being in the traditional where they don't really know what next year is going to bring. All right, so this is a client of ours that Jim and I did, actually. This is a couple. They do consulting work, and they came to us at $700,000 of taxable income after all their deductions. So all they had left was their standard deduction. They ended up with taxable income of $676,000 and a tax bill of $250,120. We gave them a 412E3 plan, annuity only, no life insurance. Their plan contribution is $405,000. That deduction brought their taxable income down to $295,000. That brought back that 199A deduction of $59,000 plus their standard deduction, and now their taxable income is only $212,000, and their tax bill is only $50,880. That's a almost a $200,000 tax savings, and their plan is to do this for the next 5 years, which will save them just under $1 million in taxes. In that 412 plan, they'll accumulate between them about a little over $2 million in 5 years. And with that, let's shift to how they would get that money out. And now I'm going to let Jim talk for a while.
Yeah, thanks, Mary. So we talked to a lot of business owners across the country that have accumulated large amounts in these qualified plans, and they're highly concerned about the tax bill when it's time to take the money out. As you can see here, there's currently, as of March of this year, about $29 trillion sitting in these accounts, all different types. DB plans, DC plans, IRAs, 403Bs, they're everywhere. And with the baby boomer generation, a lot of this money is in motion. But as you know, as we know, everybody knows that when you take $1 out of these accounts, you have to pay tax on the dollar. And Uncle Sam could want as much as 40% or more if you count state income taxes, depending on where you're at. Currently, what a lot of people do is they'll roll this to an IRA and they'll try to stretch it over their lifetime, pass it on to their spouse, take their RMDs, and then eventually get it to a child and let the children try to stretch that out, the stretch IRA planning. But that type of planning is set to expire and go away. Currently, there's two bills. One has passed the House and one sitting in the Senate. This legislation has come up for proposal for the last 5 years. This is the first year it's gotten out of committees. And the Secure Act in the House actually passed the House in May by a vote of 417 to 3. It's sitting in the Senate. The Senate has their own version. Both of these acts will push back the RMD date from 70 and a half to 72. Also, both versions will eliminate the stretch IRA planning. The House version will allow beneficiary IRAs 10 years to liquidate the account. The Senate version will be 5 years with a few exceptions. And also, both versions of this, there is no grandfathering. So we're talking to business owners that have these large sums of money in qualified accounts, and they're trying to figure out how to mitigate the tax bill. So as we said earlier, every time you take $1 out of a retirement account, you're taxed on $1. There is one exception in the IRS rules, and that exception is if that dollar is sitting inside a life insurance policy. So this is a little flow chart of our strategy on how to mitigate the tax bill on getting the money out. We've got this money, it could be sitting in an IRA, maybe it's in a 401k, profit sharing, DB plan. Doesn't matter. We're going to then roll that money into a 401k or profit sharing plan. If they already have one, that's fine. We may have to amend the plan document. If not, we can set up one for them. Once the money is in there, that's a trustee-to-trustee transfer, no tax bill. Get the money into the 401k plan, and now that is seasoned money, and we use it to acquire a life insurance policy over 5 to 7 years. At the end of the 5 or 7 years, that policy is fully paid for, and now we are going to distribute the policy. We're not going to cash the policy in. We're not going to take the cash out. We're not going to buy the policy. We're going to distribute the policy intact, the contract, out of the retirement, the 401k account. That's going to trigger taxation. And under the IRS rules, prior to 2005, when you distributed life insurance from a qualified plan, you were taxed on the market value of the policy, but they didn't define market value until this revenue procedure in 2005, which essentially was to shut down the old springing cash value strategies that were out there, and it did so. So under this revenue procedure, the IRS defines market value as the higher of the interpolated terminal reserve, or the PERC value, which is premiums plus earnings minus reasonable charges. And they go on to define reasonable charges as the actual charges in the contract. And that is a safe harbor formula, which means that the IRS cannot challenge that formula. They do leave room in the Rev Proc for you to get your own independent evaluation of the policy. They obviously reserve the right to challenge that. So we're going to stay right within their safe harbor PERC market value calculation. Now this policy is outside of the retirement account, and it's just like any other life insurance policy. You've got a tax-free death benefit, access to cash, tax-free via loans, and you've got tax-free living benefits. So we're just going to walk through a little sample case of a 55-year-old with $1 million. We're going to assume a 40% compound or combined state and income tax rate and a 5% compound rate of return. So on the IRA, effectively, if they did a Roth conversion, they would have a $400,000 tax bill, and they would net $600,000. Under our strategy, we would take the $1 million, we would take 5 or 7 years, buy the premiums, pay the premiums of the insurance policy, and you can see here that PERC market value at the end of the 5 years in this case, the value is $729,834. Now, the initial death benefit up there in the blue box was a little over $3.1 million. So anyways, we get done paying for this policy. It's worth $729,834 under the PERC safe harbor calculation. When we distribute it, now the tax bill is $291,934. So comparing the distribution of the policy to a Roth conversion, we've effectively saved this client a little over $100,000 in taxes. But most people with large accounts don't do a Roth conversion. They do a stretch IRA. So what does that look like? So there's our 291 under our strategy. And the gray bar here is the taxes added together, depending on what age we're looking at. We're going to look here at age 90. So this client, had they kept it in the IRA, compounded at 5%, they got to 70 and a half, they started taking their RMDs. At age 90, they would have, if they die at age 90, they would have taken 20 years of RMDs. So we're going to add up the taxes on all 20 of those RMDs and the taxes due on the remaining balance, because we know stretch planning is going away. And the total tax bill is $1,625,000. So when you're looking at this, you know, under our strategy here, it's the tax bill is a one-time tax bill, $291, almost $292, or would you rather pay $1.6 million over the remainder of your life? It's a pretty simple answer. Okay, so we've saved them a bunch of money in taxes, but what about the benefit side of the equation? The first column up above and the purple bar down below is if you use this policy purely for death benefit and you never accessed the cash, you never took a loan, you would pass on, as you can see here, $3.1 million in death benefit to your beneficiary. The second column and the gold bar down below is if you maximized income from this policy starting at age 65 all the way to age 100. If we add up all of the tax-free income via loans plus the remaining death benefit and look at age 90, you will have taken $2,485,000 out of the policy as tax-free to your beneficiaries. Now, the third column and the gray bar down below is if we left the money in the IRA and we took RMDs where necessary, but then we tried to match the same income stream as the insurance policy, we had to gross it up for taxes. And as you can see in red, we got to $1,437,000, and the IRA had run out of money. The fourth column and the turquoise bar down below is had we done a Roth conversion and then tried to match the income from the insurance policy, we didn't have to gross the income up for taxes because we did a Roth conversion, and we can take them out tax-free. But we got to $1,331,000, and we've run out of money. So as you can see, at every age, either of the insurance strategies, pure death benefit or maximizing income, and keep in mind clients can do anywhere in between, outperformed either the stretch IRA or the Roth conversion. Additionally, with the policy comes living benefits. On this policy, there's chronic illness, critical illness, and terminal illness as well. There's also a lifetime income guarantee. At any point in time, the client can go back to the insurance company and say, I just want a guaranteed lifetime income, and essentially turn it into something like an annuity and guaranteed. So then the next thing we want to analyze is, okay, we've reduced the tax bill, we've increased the benefits, and now this is the RMD table. And if the business owners we're talking to, they've got all this money. They don't want to lose it. They don't want to run out of money. So we've taken the RMD table and we've converted it to a withdrawal percentage, which is the third column on the screen. As you can see, at age 70, the withdrawal percentage is 3.65%. The last column is what rate of return do we have to earn to get back to break even after the RMD. It's 3.79 at age 70, but look at age 85. The withdrawal rates are huge, 6.76, and you'd have to earn 7.25 just to get back to break even. Unfortunately, interest rates are so low. It's not 1990, 95, or 6 with money markets paying 5%. This forces these clients into the stock market to avoid running out of money. Okay, Mary.
Oops.
Which brings us. Yep.
I'm trying. They're floating around on the.
Okay.
I'll get it to stated. I'm going to get it to stated sometime. There we go.
All right. Which puts them right into this path of risk. This is the S&P 500 going back to 1900, adjusted for CPI inflation. And as you can see, you know, when it goes down, it comes back. But what you can't get back is the lost time. So you can get your money back, but you can't get the time you've lost. And you look here at 26 years, 29 years, 23 years, 16 years. That's the time it took to get back to break even. You know, so if you're in the IRA, which we compounded at 5%, or the Roth, and with the market goes down, it could be a very, very long time to get back to break even. If you go 20 years, you started with $1 million and you get back to $1 million, you've compounded at zero. Well, under the insurance strategy here, if we're using an index universal life, with this one, which this one is, we've limited the downside risk to zero. Now you're limited on the upside on your rate of return. You could also use a whole life policy. We found a few that work there, and eliminate this risk altogether. If you're taking your RMDs during these down periods, then the account's never going to survive during your lifetime. So we've reduced the tax bill. Go ahead, Mary. Yep. We've significantly reduced the tax bill. We've increased the benefits. We've eliminated RMDs, and we've eliminated downside market risk. And if we use a whole life policy, market risk altogether. And we've added increased our tax-free death benefit or living benefits. With that, we will open it up.
With that, that's a lot of information in 30 minutes. I know, we know, but we wanted to kind of give you a glimpse. We cover both of these strategies in the book. Obviously, at the front end, to help business owners save taxes on the front end, get the advantage of those tax deductions, build money up, put it in a safe place away from creditors, and to help do all the good things that a qualified plan can do for that business owner, but then also help them on the back end to find a tax advantage way to get that money out, so that they're winning on both ends of the equation. So with that, we thank you for your time. I know our time is up and we don't want to hold anybody over. Beth, I don't know if you want to take it back.
Yes, I just wanted to say, I know a couple of people had asked about the presentation. Just as a reminder, in the handout section, right now, if you click on your control panel and click on handouts, you'll be able to get a copy of this presentation. And if you go to our website, pentegra.com, under our current thinking section, we have blogs, but you're also able to access either of these books there as well for your reference. And tomorrow you'll receive a copy of this recording. So lots of ways to get the information and follow back up with us if you have questions. Mary and Jim, thank you so much for being on today. Appreciate your time. Thank you, everyone, for dialing in.
Thank you.